Hey everyone, thank you for joining us for another episode of The Agent Investor. The goal of The Agent Investor is to help our audience make informed decisions through conversations with those in the commercial real estate space. Today we have a new friend of mine, Yonah Weiss of Madison Specs joining us. Yonah, thank you for jumping on.
Pleasure to be here. Thanks for having me on the show.
Absolutely. I'm not going to dive too deep into it. I'm going to kick it off and let him say what he does and tell us a little bit more about yourself and how you're involved in the commercial real estate space.
Well, my background was actually in teaching. I was a teacher for about 15 years before getting into real estate about 10 years ago. So for the past 10 years, I've been involved in various places in the real estate world. It kind of got my started in the lending side, commercial mortgages, and underwriting, and then I got my broker's license. I did some fix and flips, but for some reason, it all led me to cost segregation, what I'm doing now. So that was about 8 years ago that I got connected with Madison Specs, the biggest national cost seg company. I know a lot of our listeners might be thinking to themselves, what in the world is cost segregation? We're gonna explain it. Don't worry, just hold your horses. We'll get there. But essentially, it's a tax strategy for real estate investors, and I basically used my teaching background to hone in on the fact that the vast majority of real estate investors that I came in contact with had no idea what cost seg was at all. And so therefore they weren't able to utilize this incredibly powerful tax strategy. Essentially, the number one reason why real estate investors pay little to no income tax is the use of cost segregation. It's one of those things that is just incredible. Sounds like almost too good to be true, but it's directly in the tax code, and it's something wonderful. Through that, I have been extremely involved in social media and in networking, and built my network through that to the point where I started a podcast, and I speak at various conferences all around the country. And I just really love it that it is giving me the opportunity to be involved in the real estate world on multiple levels, because our clients are in every single asset class, in every state, every market in the country. So it really gives me a bird's eye view of everything that's going on in the commercial real estate world, and allows me to advise my clients in the same way.
Got it. Great intro. Yeah, definitely, the hook I heard there is just folks just don't know this space, and you be the go-to guy, as it says, the cost seg king that people come to for this space is a great thing. Let's dive right into it. So fundamentally speaking, what is a cost seg? And I know bonus depreciation is part of that. So maybe kind of, what is cost seg? What is the bonus depreciation? What is it fundamentally?
It's an advanced form of depreciation. So I mentioned it's a tax strategy. Basically, what that means is that anytime you buy a property, whether it be a commercial or residential property, you're able to claim a tax deduction called cost segregation. Okay, essentially, it's called depreciation, basically. So what depreciation is, it's a borrowed term. It doesn't actually mean that your property is going down in value. It just means that because you bought this property, the IRS now allows you to take this deduction based on the value of the property to essentially write off the entire value of your property over a long period of time. So regular, what's called straight line depreciation, is a deduction that allows you to take 2 to 3% of your property value as a deduction every single year. Okay, so for residential properties, it's over a 27.5-year period. Over commercial properties, a 39-year period. And essentially, like, what that does, it allows you to take this deduction and pay less taxes. Cost segregation, as I said, is an advanced form of that. Basically saying that there are certain components within the property that actually depreciate faster than that 27.5 or 39-year period over a 5 or 7 or 15-year period. So what the cost segregation does, and just like the name sounds, we're segregating the cost. We're taking the value of the property and breaking it down into different buckets, different categories, and identifying the value of those components. Like, for example, furniture and fixtures and appliances and things that are personal or movable property are considered 5-year value depreciation, which means I can now take that value and take it as a tax deduction over the first 5 years. And you mentioned bonus depreciation, which actually is a term for allowing you to take 100% of those 5-year deductions in the first year. Okay, so essentially, it's a cash flow mechanism that allows you to take this. You have this pool of potential deductions that you may never see. Okay. And instead of taking a little bit every year, you basically get to front load a huge chunk of that, maybe 20 to 30% of that in the first year, the first 2 years. And it allows you to, like I said, pay little to no taxes.
No, very good. So, kind of in the way I'm seeing it, it's helping them offset their taxes. So they're not actually collecting money. It's more so offsetting taxes, which ultimately will offset money because you can keep the cash flow you made that year or whenever to redeploy that and more, basically accelerating your money versus waiting longer to utilize your money over time.
The goal is to reduce your taxable income to zero, right? If you make $1 million and you have a huge tax bill, let's say you're paying 35%, you're going to pay $350,000 to the government. But if you have $1 million of deductions, then you essentially offset your taxable income. And so you have zero taxable income now because of all of those deductions. And instead of paying $350,000 to the government, you pay zero. And that's, basically how it works.
Got it. Very good. All right. No. So next question I have is regarding the different asset classes. When investors are thinking of cost seg in the different asset classes, such as multifamily office, mobile home parks, what should they be considering? What they should be thinking about? Maybe what are the differences when it comes to cost seg?
First of all, we always like to run a free estimate for anyone who wants to know, like ahead of time, if they're looking at a property, thinking about it, because knowing, part of the education of this, like I said, people just don't know what it is. You don't know the actual value, you know the potential value in that. But yeah, every single property has potential tax savings. Some are better than others. So you mentioned multifamily, great asset class, typically around 20 to 30% of the property value is going to be in that accelerated depreciation category. Okay, so what that means is, first of all, we take our purchase price, we have to subtract a certain amount for land. Land itself does not depreciate, but whatever's left over, and typically land is about 10 to 20%. There are certain areas in the country where it can be higher, but and certain areas where lower, for that matter. But for basically, once we reduce that tax basis, what we're left over with, we can now take 20 to 30% of that and take it as a first year tax deduction for multifamily. Mobile home parks are on a much higher end because first of all, there is land, obviously, you subtract the land, but there's usually nothing else, okay, besides for the land improvements. Land improvements depreciate on a 15-year schedule, which is accelerated depreciation, eligible for that first year bonus depreciation. And so land improvements means the landscaping, the pavement, the concrete pads under each home, fencing, any type of, even, the roads, pavement, gravel, anything like that. And even now, basically a new law was passed recently that shows that even the infrastructure that normally used to be on what's considered the 27.5-year structural components of the property, like electric, septic, water, infrastructure, all those things have value. Every component of the property has different values to it and are going to depreciate over those respective timelines. Mobile home parks just changed the rule that allows you to take all that infrastructure on the 15-year schedule as well. So now we're seeing mobile home parks where it used to be 50 to 80% of the property value going into that accelerated depreciation category, which is huge, like double or triple the amount that multifamily property would have. Now we're actually seeing upwards of 90%. Because of that change in the law, which is it blows your mind if you think about it. Because again, it's based on the purchase price and not based at all on how much money you actually put down, which means, let's say you bought $1 million property and you only put 20% down, okay? You put $200,000 down payment, and now you do a cost seg and you can take $800,000 or $900,000 deduction in the first year, even though you only took $200,000 out of your pocket to pay for that. So it's literally mind-blowing.
Yeah, absolutely. One thing I'm still personally not clear on 100%. Who's the biggest beneficiary of cost seg? Someone who is a real estate professional, say someone's a doctor and they own a building versus someone who is a full-time real estate investor. Is there any difference in, those folks versus the other, or?
I'm glad you brought that up because there is absolutely a difference, and unfortunately, it doesn't get spoken about enough, and people have a misconception. One of the biggest misconceptions I would say about cost seg is that depreciation is considered a passive deduction, which means it can only be used to offset passive or rental income. Unless you, and there are a few exceptions to that. The most notable exception is if you or your spouse are a full-time real estate professional. It's called REPS, R-E-P-S, real estate professional status. And it's an official status the IRS has that says if you meet these certain qualifications, the first one being that you don't have another full-time job, your full-time job is in the real estate world. The second qualification is you need a minimum of 750 hours a year of working hours, meaning you can't just like retire and do nothing and still have this status. Once you have this status, you can now use depreciation or cost seg to offset any source of income. So it's no longer limited to just your passive income. Whereas a doctor, as you mentioned, even if they buy a property and do a cost seg, those deductions will be limited to only offset their rental income. And which is, it's great in and of itself, because if you, there's basically no other type of investment out there that allows you to take this deduction against your income from that investment, and so you will essentially pay no taxes on the income coming from your property or even multiple properties, which is another thing. If you have depreciation from one property, it can be used to offset the income from other properties, but you have that limitation where you cannot use it against your W-2, you cannot use it against any other active income. Even stocks, that's considered portfolio income, is also considered active. But if you or your spouse are a real estate professional, then you don't have that limitation, and it's basically the best thing since sliced bread.
It seems like it's not heavily, but definitely favorable for real estate professionals. But someone say is a doctor, why would they do a cost seg? What benefit is it to them?
As I mentioned, it's going to reduce your income from any of your rental income, which if you have multiple properties, you may have more income than your regular deductions will cover. So it's a great way to just kind of make sure that you're not paying any taxes on that. Another great thing is that it can be used actually to offset passive gains as well, which means if you sell a property, you don't have to be a real estate professional. You don't have to do a 1031 exchange to, which would normally defer your capital gains and your recapture tax. You can do a cost seg on one property to offset the gains from the sale of another property. So you can literally wipe out capital gains tax on a property. And there are multiple reasons, but I think the biggest reason would be just to, reduce your taxable income as much as possible. Even though it's not going to be as beneficial if you're a real estate professional.
Thanks for the clarity. How early in the acquisition process, should someone start to talk with someone like yourself? And, just generally speaking, what does that process look like, once they do engage with you and you initiate a cost seg? So kind of two different questions there, but go for it.
Yeah, I'll put it together because we always like to run a free upfront estimate analysis. And this can come even during the due diligence phase, meaning if you're under contract or you're looking at a couple of properties and thinking what would actually be the tax benefit if I did a cost seg, we can run the numbers. Just takes about a day or so. Just really straightforward, gives you that knowledge that allows you to make a more educated decision to see if it does make sense or not. The process from there is pretty straightforward. It's about a 3-week process. It's not very complicated. We always do an engineered site visit to the property, although we do most of them remotely now, which means through a video call or FaceTime, Zoom, something like that. Because the engineering component is the most important part of the cost seg study. So just to kind of clarify what that means, the IRS has given these rules that says different components of the property depreciate on different time frames. Like I said, 5 or 15 or 27 and a half year. But you have to identify, you have to be knowledgeable in construction engineering to know what those are, and to identify them, then to create this very detailed report. We create this report that's 100 pages long, very detailed, going into all the nomenclature that needs to be used. There's a whole numbering system the IRS requires for that, and showing where these different components fit within the tax code. And then you basically just hand that off to your accountant and the new depreciation schedule that we create. And all the accountant needs to do is basically copy and paste those numbers into your tax return. So it's a very streamlined process, very simple, not a lot of involvement on the part of the owner. Because people don't want to have like an extra job, something else to take on them. And the amazing thing is that accountants love this because it's something that most accountants cannot do on their own because of the engineering component. Don't get me wrong, there are some of the big accounting firms out there do have engineers and do cost seg in-house, but 99% of accounting firms out there do not have that capability. So it's a great partnership to have someone to be able to do that and team up with your accountant to do that.
No, very good. Give me three common misconceptions that you often hear when it comes to cost seg in your space from owners and investors.
Biggest misconception is that their accountant is doing this for them or their accountant
Mm.
can do this on their own. The second biggest one I would say is that this needs to be done in the first year of ownership. It does not. You can actually do this at any point when it most benefits you, which means if you bought a property 5 years ago, we can do a cost seg this year. You do not need to amend previous year's taxes. All we do is we catch up the missed depreciation and you can apply it going forward. So you get basically like a big chunk of deductions of those missed deductions this year and going forward. I think the third biggest misconception is that it has to be a very expensive property to be worthy of doing a cost seg, and it's totally not true. Anything purchased over $200,000 is already like well worth doing a cost seg on or looking into it. The cost is not that much. It used to be, years ago, used to be, $10, $20, $50,000 to do a cost seg, which sounds crazy to me right at this point. But, nowadays, it can cost just a couple $1,000s. And as of now, at the time of this recording, it's basically like our low end is about $3,000 for like single families, for example. And for most commercial properties, between like the $5,000 to $7,000 range. So it's really not that expensive and is never going to be contingent on the tax savings. Our fee is a flat fee based on the size and type of property, which means if you buy $1 million property and you're going to get like a $200,000 tax benefit, and you buy a $10 million property and get a $2 million tax benefit, our fee is going to be the exact same basically for those two properties. At least makes sense to look into. And there are many more misconceptions, but I think those are the biggest three.
Got it. You actually answered a question that I had, and it was regarding, the size or price point of a property. It's good to know that this can be applied to smaller properties as well. And it seems like it makes sense more for properties that you plan to hold, because I'd imagine if you fully depreciate a property in year 1, 2, and then you sell it 2 years later, you're really paying a pretty hefty tax bill, I'd imagine, to recapture all that. Is that accurate?
Well, there is something called recapture tax upon the sale of a property. So if you're taking a big chunk of depreciation up front, you're going to be hit with that recapture tax on the sale, within. So yeah, I would usually say like a property that you're planning on holding for at least 2 years, that's when it makes sense to do the cost seg. But the recapture tax in of itself is a big misconception. We can get into that if you want, but
yeah, go for it.
It's because, some people think recapture means I have to pay back the depreciation, and that's not what it means at all. Okay, recapture is the name of a tax, and essentially you're taxing the amount of depreciation taken, which is very different than paying back, right? If you take a $100,000 deduction, and on the sale, a few years later, you have to pay, a 25% tax on that. That's very different. And $25,000 is very different than $100,000 of paying back. So that's the first point of that. The second point is there's a big difference between being subject to a tax and having to pay a tax. Okay, legally, there are many ways to reduce or defer or completely offset and eliminate that tax upon the sale. So it's not, accurate to say, oh, if I buy the property and do the cost seg, I'm just going to have to pay it back or have to pay this big tax when I sell it in a few years. That's not usually the case, because if planned accordingly, you can actually, like I said, either defer, reduce, or completely eliminate that recapture tax, combining multiple strategies, which are not too complicated. But again, it does take tax planning. It does take, thinking about this ahead of time and not just, winging it and going on the fly.
With the book Who Not How, and it really kind of talks to like making sure you have that team in place, and because it's just too complicated for folks to take on their own and make certain assumptions, too expensive to make certain assumptions in this space, and just engage with the right people up front and trust them and let them do their jobs versus winging it. But that's very good advice, and even for me, that's very good advice. So we are starting to wrap up. That went by pretty quick. Like I said, you're very smooth and you know your stuff, which you do because you're the cost seg king. But all right, cool. So kind of moving to more personal questions here. Sure. When you're not helping clients with with their cost seg work, what do you like to do personally? What are some of your hobbies?
Well, I am married and have 6 kids. My oldest is 21 now, so that explains all the gray hair in my beard. So I have a few teenagers at home as well. But so I mean, basically when I'm not working, spending time with them, definitely enjoy going out into nature, whether it be going on hikes or the beach, things like that. And I love My youngest, who is now 11, is very active, loves to skate, rollerblading. I actually used to play hockey when I was little, so I'm still
Nice.
still enjoy that. So we do, go to the skate park and do that. So that's a lot of fun.
Nice, nice. It's nice to have a little bit of youth behind you to kind of keep things going. That's all super exciting. How can folks find you, get a hold of you? What's the best way?
Well, I'm very active on all the socials. I would say LinkedIn is my biggest platform, but on X and Instagram as well. Just take a second, instead of just hitting that follow button, take 10 seconds literally and write a little note, just saying that, hey, I heard you on the Age Investor podcast, or whatever you want to say. Love to connect with people. You can also go to yonahweiss.com to learn more about everything that we're doing, not just the cost seg, about the investing side, and our podcast, Weiss Advice, as well, which Brandon was just a guest on. So, yeah, definitely check all that out, and happy to connect.
Any final words for the audience before we take off?
I would say the biggest advice I'd have for anyone, especially if you're starting out in this business, but even if you're involved, continue to network and connect with people who have been in the business for longer than you have, and just team up with people and see if you can find a mentor, people that have done things before. You don't need to reinvent the wheel, but collaboration is really the key.
Absolutely. All right. So with that said, we want to thank you all for joining us for another episode of The Agent Investor. We want to wish you all the best in your health and happiness. Yonah, thank you so much for joining us. It was a pleasure. And to our audience, we will see you all in the next one. Have an amazing month ahead. See you soon.